Good morning, everyone. Thank you for joining us for today's webinar on essential actions to be taken before the year end from a corporate tax and transfer pricing perspective. I have with me Sahil Sharma, who's a director in our transfer pricing practice, and Maulik, who's a senior manager in a corporate international tax practice. I am a director and lead the direct and international tax practice here at Andersen. With this, we can start the session. Sahil, could you confirm whether you can see my screen or not?
Yes, I can. Yeah.
Okay, great. And thank you again, everyone, for joining today's session. And like I mentioned, why is this very important? Because, we've already almost entered the last month of the first tax period for many taxpayers. And the corporate tax law, as everyone knows, provides statutory timelines to carry out administrative work like, registrations, re-registrations, and like. The corporate tax law is also a very progressive law. It provides a lot of elections to taxpayers where you can elect to, offer some things on a realized basis, where you have to make an election whether to form a tax group or not. The multiple elections, and those elections also have to be analyzed ideally by the end of the year. Transfer pricing, which Sahil will touch upon, is such an important action to be undertaken, and and it's should be done in a timely manner so that your books for this financial year 24 should at least reflect your arm's length transactions before you close them. With this, I hand it over to, let's you know, first touch upon the corporate tax part, and I hand it over to Maulik. Maulik, over to you.
Thank you, Prateem, for the very detailed introduction. Um, but I suppose like before we dive into like the specifics of corporate tax and transfer pricing, I'd like to address first things first, right? And that, in my opinion, is readiness of a company. And by readiness, I mean more so from a tax technology and IT perspective, right? So if you look at the corporate tax return, it is very information heavy, and you have to address like a variety of data points, right? So clients and companies and businesses should ensure that their ERP systems are aligned and that their ERP systems are sophisticated enough to extract the data to meet the data needs and the information needs. You will see there is a very close connection between the financial reporting function of a company and the preparation of a corporate tax return or the corporation tax compliance process, right? Because essentially what you're doing is you're using components of the financial statements to prepare your tax computation and subsequently your tax return as well. So if you haven't considered this just yet, I think it's essential to align your ERP system with the new UAE CT law and ensure that all the intricacies are taken into account. Um, Moving on, I think I'm just gonna dive into it now. So essentially, when we're talking about actions before year end, by year end, I mean 31st December 2024. I think the first thing that comes to mind is the statutory deadlines, right? And within that, I think something that really jumps out is the corporate tax registration. So by now, most of you might be aware that all taxable persons are required to submit a tax registration application to the FTA, right? And there are certain stipulated deadlines by which this is meant to be done. And the deadlines are decided by reference to the date on which, by date, I mean the month in which a trade license was issued. Um, Like, I think we're pretty late in the year now, so the only deadlines that remain would be the November deadlines and the December deadline. And these are only applicable to companies for which the trade licenses were issued on or after 1st October 2024. I'm sorry, the date is irrelevant in this case. It could be any year, so on or after 1st October. So essentially, if you haven't considered this, do take this into account, because if you do miss the stipulated deadline, there are substantial administrative penalties that are applicable. And in this case, it's 10,000 AED. So it's in our best interest to avoid that. Um, Prateem, in his introduction, did touch on tax group applications. Right, so these are required to be made before the end of the first tax period. So if you're following the calendar year end, this is to be made before the 31st of December 2024. Now, this is an optional regime, so it is important to bear that in mind. It does not apply to each and every taxpayer, right? So I think you really need to consider this in light of the structure within which a company operates. There are a lot of administrative advantages on paper, but in some case, this might not work well for you because of the structure within which, or the organization within which a company operates. If you haven't considered this just yet, I think it's important to take prompt action, because the deadline's creeping up on us and we're headed into the holiday period as well. So, Christmas is right around the corner. So if you want to have a conversation on this with us, feel free to reach out.
I think, Maulik, thanks for that, and that's a very important point. I think one thing that I think the listener should be aware of is some practical challenges with tax group applications that could arise. If you haven't already moved to register the individual members of the tax group, I suggest do it now, because the FTA could practically take some time to approve those individual registrations. And pursuant to that, you could practically only file for the tax group, application. So, you should not delay further, because if the FTA takes more than required time to at least approve the individual registrations, then you might be in a bind as to your, last minute rush during the holiday season to, file the tax group application.
Yeah. Thanks, Prateem. That's very helpful. Also, I think we do have to assess like the commercial and economic realities as well.
Yeah.
So I think there's a good bit of work that goes into it. But thank you for that. And so moving on, right, I think I'm just going to touch on dormant entities and entities under liquidation. Especially, I think you see scenarios where there are certain like large groups, and due to say reorganization or restructuring, there are certain entities within the group itself that are dormant. So it's important to bear in mind that a dormant entity is a taxable person as well, and they're required to register for corporate tax purposes. Coming to entities under liquidation, right? So I think one consideration that we should actually factor in is the fact that these need to be deregistered, right? So if an entity has been liquidated, then we need to submit a deregistration application within 3 months of the date the entity ceases to exist. This is something that's easily overlooked and oftentimes missed, because obviously these entities are dormant and they're just sitting in the group. But I think we have to factor these considerations in as well. Lastly, in terms of the statutory deadlines, then, right, I think we all know at this stage, we're aware that the UAE CT law applies to periods commencing on or after the 1st of June 2023. So where there is a short tax period, so a period that ends on or before the 29th of February 2024, the FTA has offered an extension wherein you'd be considered to file your return on time, where you file it before or on the 31st of December 2024. So if there are entities, say, in your group structure or standalone entities that have a short tax period, then this is applicable to you. And this is something that you have to move fast on, because like I said, like 31st December is just right around the corner. Right. So now that we have the statutory deadlines out of the way, it's important to consider various elections, even though you don't need to have most of these pinned down by the 31st of December of this year. But I think this is something you should work towards and you should consider before the CT return filing deadline, which in most cases will be 30th September 2025, right? But there is a decent amount of work that goes into this. So I think, we should essentially start as soon as possible. The first election that I'm going to talk about is the realization basis election. So essentially, where there is a taxable person who prepares the financial statements on an accrual basis of accounting, they may elect to take into account their gains and losses on a realization basis. So essentially, the impact that this has is that all unrealized gain and losses that are recorded in the taxable person's financial statements, they're ignored or disregarded for corporate tax purposes. So when you're calculating your taxable income, you can choose to ignore the unrealized gains and losses from your taxable income calculation. And this is, well, applicable in scenarios, say, for example, if you have like certain assets and there are, say, for example, a lot of like fair market value movements, and you expect these movements to be volatile and you expect these movements to have an adverse impact on the tax liability for the period and for the periods going forward, because bear in mind, this is an irrevocable election that can only be reversed in exceptional circumstances after seeking prior approval from the FDA. So yeah, where you do expect a lot of volatility, it's important to take this into consideration, bearing in mind that it is an irrevocable election. Right. So the next point on our agenda are the transitional rules, right? So, and this essentially applies to a taxable person with certain qualifying financial assets or qualifying financial liabilities. It also involves immovable property and intangible assets as well. So, say for example, if you owned these qualifying assets before the first tax period, and these are recorded in your financial statements on a historical cost basis, then you may elect to adjust your taxable income to adjust out essentially any gains and losses that are arising from these or that accrue to the company prior to the first tax period, but would essentially be realized when a disposal of these assets are made in the future, right? This is there are a lot of sort of intricacies involved, and I think you do have to see this from an accounting perspective as well. So as there's a lot to consider over here, um, and I think the complications also arise given the fact that this is an irrevocable election, as is the case with the realization basis election. So I think this needs to be considered in detail because it is a complex set of rules. So the next relief I'm going to touch on is the small business relief, right? And as the name suggests, this is beneficial for small businesses. And it's important to sort of make a note of the date of 31st December 2026 as well, because this is only applicable till then. And this is an annual relief, and you have to sort of like consider the conditions year on year. So essentially, right, where a taxable person has revenue of AED 3 million or less in a relevant tax period, and they do not form part of an M&E group, then they can essentially go ahead and make this election. Right. I did mention an M&E group. So just to sort of provide you a brief background, an M&E group is essentially made up of like two or more companies that are resident in two or more tax jurisdictions or countries, and that consolidated revenue for the period is in excess of 3.15 billion AED. Um, Essentially, the impact that this relief has is that the taxpayer who's elected for this relief doesn't have to calculate their taxable income, and consequently, they do not have to pay any corporate tax on income earned in that tax period to which this relief applies and to which period you've elected for this relief. The next two sort of reliefs, I think I'm not going to get into a lot of detail because these are sort of quite complex and they only apply to certain groups, that have a lot of restructuring and transfer of assets within the group itself. But just to provide you a brief background. So I'm going to touch on transfers within a qualifying group first, right? So when there are certain transfers of assets and these transfers are within a qualifying group itself, then these transfers can be deemed to made on a no gain and no loss basis, provided that the transfer, as in the person who's transferring these assets, elects to make that election. It's important to bear in mind that these assets and liabilities need to be held on the capital account, and this is an irrevocable election as well. So, it's only reversed in exceptional circumstances following the approval by the FDA. Moving on to the business restructuring relief then, right? So this essentially what this relief does is that it eliminates the corporate tax impact or the UAE CT impact of certain transactions that are undertaken as part of a restructuring or reorganization. This election does not apply to any future periods. It just applies to that specific tax period in question where you've had those restructuring or reorganization transactions.
Thank you, Maulik. I think, like you mentioned that these are not time bound for 31st December. However, these are, while someone would say that these are good to haves are not must haves, but this will become a must have soon. And, every group should know which direction they're heading with these elections, ideally by the end of the year. And especially, for, creating the liabilities or knowing, what assets to create from a tax perspective and from a tax accounting perspective at year end, something that Maulik will touch upon. But it's good to know, so while these are not must-haves, but it's close to it. I think one group should not, defer this beyond, the December, at least mid-December, to know which directions they're heading, with these elections, especially realization basis, elections, transitional rules. This will have a material impact on your taxable income and ultimately your tax liability for next year or first tax period. When it comes to, your foreign PE exemption, practically we have seen this becomes important if you're forming a tax group, because one essential conditions where TP applies to a tax group is when, a tax group has a foreign tax credit available to it. And there is an interplay between, having a foreign branch and, whether you want to include this foreign branch in the tax computation of the tax group and take a foreign tax credit vis-a-vis excluding it. And it could have a material impact, from a transfer pricing perspective as well. So these elections should be, at least working should be done. And like Maulik mentioned, it should not be rushed. There should be a proper, you know, quantification of the pros and cons of going either way and taking a very informed decision before opting for, one course of action. And a lot of them are irrevocable. So, it should be done with a proper and detailed study.
Thank you, Prateem. Right, that was helpful. So moving on, obviously we've spoken about like the statutory deadlines and we've spoken about like the various elections, but there are also certain other things or certain other considerations that we have to factor in, right? The most important one that I can see over here is the qualifying free zone person. Like this could be a conversation for another day, and like we can literally talk about this for hours. But in year one, I think essentially you need to sort of make sure that you comply with the conditions, because then if you don't, then you cannot benefit from the 0% corporate tax rate arising out of this for the next 5 years. And Prateek, over here is actually the qualifying free zone person expert. So Prateem, do you have anything to add over here?
You're being very kind, Maulik here. But yeah, I think, for groups or companies, I think more or less people are aware of the law. But I think, some things, basics or some fundamental aspects of the law, it's important to highlight them, that, these conditions cannot be, um, you know, abided by from mid of the year. This is something that most companies or any free zone person that's willing, wanting to take the 0%, they must ensure that they comply with the prescribed conditions, for the entirety of the year. Wherever, there are gray areas, it is good to assess them and see, you know, how it might interplay with non-compliance of any conditions, or are there any positions to be, taken, technical positions, or, looking at the practical or commercial realities of how the business was conducted. But yeah, the kind of the conditions do have to be met for the entire year. And there are six important conditions. So it cannot just be that I'm earning income for the entire year. You also have to ensure that you comply with the substance requirements throughout the year. And that can be practically tricky. And one must analyze this in a detailed manner. Another part which Sahil will be touching upon is transfer pricing. It cannot be that you do everything and you forget about transfer pricing, and not meeting arm's length is a complete no. It should be done, you know um, and closed before you close your free zone person books, and compliance with it is absolutely mandatory, as it's a mandatory condition to get the 0% benefit.
Thank you, thank you. And while we're on the subject of benefits, I'm just going to move on to tax reliefs. So um, these are important and they are essential in the sense that they have the effect of reducing your corporation tax payable or your corporation tax liability for that period. Um, the first one on my list is tax loss. Right, so just to sort of briefly explain the concept, right? So when a taxable person's deductible expenditure in the period exceeds its income, then that gives us a negative result. And that negative result or that negative answer is your tax loss for the period. This tax loss can be utilized in a variety of ways, right? So the company itself can carry this forward to future tax periods indefinitely. So say, for example, if they have like taxable profits arising in 2025 or say 2026 even, then they can use a portion of this loss to offset a portion of the taxable profits. And there is a limit to it, so we need to take that limit into consideration as well. The other uses can be you can transfer these losses to qualifying group companies, right? So it doesn't necessarily have to be a tax group. You can transfer these outside of the tax group to other group companies, subject to certain conditions being met. And that's an important caveat over here, and that's an important caveat in a lot of places, right? So there are conditions attached to it, and you need to ensure that the conditions are met. Um, the company in turn can also claim, say, tax losses, so they can surrender their losses, but they can also claim tax losses from other group companies. So that's one very important point. Moving on, foreign tax credits. Prateem did mention it, right? So I think essentially where a UAE company pays tax in a foreign jurisdiction on foreign source income, then they can claim these back. And well, the amount that you claim back is based on a certain formula as prescribed for in the UAE CT legislation. So, you have to do your workings, and there is that added burden of doing that compliance. I think one scenario that I can think of is where you don't opt for the foreign permanent establishment exclusion, and you take into account the profit and losses of the foreign permanent establishment or the branch or the foreign presence that a UAE company has, then they can claim back to a certain extent based on the formula, the taxes that they've incurred in the foreign jurisdiction. Um, Again, there are administrative burdens to it. You have to consider it, and there are certain nuances and aspects that you need to take into consideration. Um, the next one is the participation exemption, right? So where a UAE company has a participating interest for say a certain period of time as specified in the UAE CT legislation, then any gains and losses arising out of these will be exempt from corporate tax. And when I say gains and losses, this includes like say, capital gains arising say on disposal of a subsidiary. But it is important to make a note of all these participations that you have, just to have like a register with details such as the name of the entity, the jurisdiction in which they're tax resident, say the date of acquisition, the base cost on acquisition, date of disposal, if any, and the consideration on disposal. So it's nice to just track this information for your own records in case your tax advisors or us ask for this information. And the next point is more on tax provisions, right? So a tax provision is essentially, I'm not going to get into heavy details, but just to give you a brief overview, it's just an estimate of your corporation tax liability. And as part of that, you can calculate your current tax payable and your deferred tax asset or liability in the period as well. And these numbers are usually used for inclusion in the financial statements as well, which in some cases are required to be audited, right? So as part of the provisioning exercises, you can essentially figure out what your material adjustments are, right? So there are certain items that are tax sensitive, especially say the first thing that comes to mind is the interest capping rules. So say if a company has like substantial interest expense in the period, then the interest expense is only deductible up to 12 million AED or 30% of the tax EBITDA for the period, whichever is higher. So I think this is specific to financial services companies, but other companies as well that have like loan arrangements in place and so on and so forth. Another thing that comes into mind is entertainment expenditure, right? So if this isn't, say, spent on employees wholly and exclusively, then it's only deductible up to 50%. So the other half or the other 50% is not allowable for tax purposes. Um, and my last point before I hand it back to Prateem is, there are considerations for non-resident taxable persons as well. So I think they need to sort of determine and establish if they have any presence outside of the in the UAE or outside of their tax jurisdiction. So if they have a nexus in the UAE, say if they're earning income from an immovable property, or if they have, say, a permanent establishment, which could be a branch, a head office, or distribution activities, then they might have to consider the impact of the UAE CT law. So I think this needs to be considered, and you need to bear this in mind as well. Pradeep, that's it for me. So I'm going to hand it back to you.
Thank you. I think that was, very, very comprehensive, Maulik. And, you covered a lot of important points as well, whether that be, just mere compliance from a registration point of view or evaluation of elections. And also, I think, what you touched upon, the tax accounting part, this is the first tax year. So getting this right now and for the first year is essential. And, there could be speaking from experience in complex tax jurisdictions, there could be multiple areas where, that would not have been envisaged as a complex area or somewhere that needs a further review, but it just springs up when you start doing your tax accounting. So, there could be things like where you have to make a judgment on, bifurcation or allocation of expenses between personal and business, just, between exempt and non-exempt income. So detailed workings are required, and it is essential to get this done even for non-residents that are in UAE, like Maulik mentioned. Basically the UAE law says that you can generally get a fixed place PE if you're in UAE for show that you're in UAE for 6 months or more. All these conditions have to be seen and have to be evaluated whether you trigger these rules for non-residents by the end of the year or not, and whether you're required to carry out you know compliances arising from there. With this, we'll transition to the transfer pricing section, but a request to all, you know, participants and people who are listening in, please share your queries. Please answer certain poll questions that may have been raised. It gives us insights as to what is your, what are the, assistance that you're looking at and what are the problems that you're facing and your questions. Please feel free to send them. We will have a short Q&A sessions at the end of the session, and we will try our level best to resolve them. If we can't, address them now, we will definitely reach out to you separately after the session. With this, Sahil, over to you with the transfer pricing section. I think Sahil, you're on mute.
Yeah, can you hear me? Thank you, Prateem. Thank you, Maulik, for the exceptional presentation on corporate tax. And now we move on to transfer pricing. So when we talk about transfer pricing, as per the UAE CTA law, the transfer pricing rules are applicable not only to domestic transactions, but like to all taxpayers, be it within UAE, mainland or free zone, as well as for your transactions, which are related party transactions. What that means is the impact of the analysis you do from a UAE perspective might have far-reaching impacts on how your group operations are structured. Therefore, at this point, what we would expect is that for taxpayers at this point in time to have at least be in the finalization of the pricing policy, or at least would have started with the groundwork, laying the groundwork for transfer pricing. When we talk about a transfer pricing policy, then the first step is the identification of the related parties. After the UAE CTA law, related parties are structured into 4 different categories, which would be kinship, ownership, control, and connected persons. The key challenge here would be to actually focus more on the kinship and the control aspects, because as for the kinship, it's basically covers your related person relationship for up to the 4th degree, which means like related parties, your uncle, aunts, great grandkids, and grandparents. And these could be related not only by blood, but by also affiliation, which would mean it translates to your spouse and then their great grandparents and grandkids and uncles and aunts, as well as any adopted guardianship. So the range for kinship is quite wide, and it's very important that before we start with the transfer pricing assessment, we can identify each and every related party to be covered. And it's especially applicable for the UAE, where a lot of businesses are actually family owned, and hence there might be transactions which are legacy transactions between those related parties. Yes, Prateem, I think I would be taking control of the presentation. Yeah. The second part actually is control. So as per the UAE CTA law, control has been defined by either you have the control of the majority of the board of directors, which means you have decision-making controls, or you have access to, or you're eligible for more than 50% of the profits in one entity. But the final sort of challenging aspect of control is the exertion of significant influence. Now, significant influence has not been defined in the UAE CTA law. However, they have given certain examples which we can sort of use as guiding principles, but those are not exhaustive principles. Some examples of control could be that your business is reliant on an exclusive patent or a trademark which just is owned by the related party without which you cannot sort of continue your operations. It could also be from a situation where you have a debt from a related party which constitutes more than, I think, 50 or 80% of your total net asset values. Or it could be coming from a perspective where your business again is like, there's an arrangement between your related parties where they can extract more than 50% of your entire profit. So if you have these situations, it becomes really important to take into account those arrangements and identify whether they are supposed to be treated as related parties or not. The third point, I think, would be connected persons. Now, connected persons have been defined as either directors or officers of the company, and they are the people who can actually exert, again, significant influence on your operations. So once we have identified who these related parties are, we move on to the second step, which is the related party transaction mapping. Now, when we talk about related party transaction mapping, for transactions which are hitting your P&L, they would be pretty much simple to identify because, like, say, if you're purchasing or selling to your related parties, or you have an intercompany loan with them on which you're paying an interest, or you're receiving certain services from your related parties or providing them. Now, these transactions hit your P&L, and in most scenarios, they would be easy to identify. The challenge comes from this aspect that the transfer pricing laws are applicable also on intercompany arrangements. So what is the difference? An intercompany arrangement could be, say, an interest-free loan on which you may or may not have an intercompany loan agreement, but because there's no interest rate charge, it might not hit your P&L and it might be overlooked when you're doing this assessment. Similarly, there could be loans in which you have a third-party loan, but one of the group entities has provided a corporate guarantee, or one of the UBOs has provided a corporate guarantee. So when these are the situations which are tantamount to being explicit corporate guarantees, you have to ensure that they are at an arm's length and they are assessed appropriately in terms of your transfer pricing. Coming to the connected persons, now those transactions, as far as their compensations, including bonuses or incentives, those would be easy to identify. But there could be a situation where maybe you are renting out an apartment to one of your connected persons, or you are maybe leasing out certain vehicles, and these may or may not hit your books. But these have to be taken into account as well when you're doing the related party transaction mapping. Once you've identified your related parties and you have mapped the transactions, we move on. Okay. In the slides, can you move on? Yeah. We move on to the step 3, which is conducting a functional asset and a risk analysis. Now, this part is the most important part of your entire transfer pricing exercise, because this, first of all, starts with the evaluation of your entire group value chain. This would not only consider your entities which are within the UAE, but also entities with which you are transacting, and they are overseas-based entities. This time, based off the group value chain, we would be identifying which entities are performing key value driving functions, where are the entities who are taking the significant risk, where are your C-suites located, all of those structures, the organizational structure, the functional organizational structure in terms of designation and departments which are located in each of the entities and the countries. Once we have the group value chain, we move on to identifying individual functions performed, assets employed, and the risk that entities are taking when we are taking those intercompany transactions. Based on this FAR analysis, which is a very heavy exercise, which includes, like, having functional interviews with your respective personnel, with like the C-suites with different entities, both domestically and overseas, we can conclude this FAR analysis by having a characterization of those entities. What a characterization means is what technically, when we talk about that particular intercompany transaction, how would that entity be profiled? So for example, if you're into a trading of commodities, a function analysis would help us define, are you just a buy-sell entity, or are you a full-fledged distributor who's having a trademark, who's incurring significant marketing intangibles and bearing significant market risk? Or are you just a low-risk distribution who's purchasing products from your group entities, working under their guidance, and just selling to your third-party customers? So this categorization is very important before we move on to the final step, which is the step 4, and that is performing an economic analysis. Yeah, Prateem, can you move to the next? Yeah, the economic analysis is technically starts from identifying what your current intercompany pricing policy is, which would be either be a cost plus markup. It could be based on your comparable data from your market research and then defining your markups or whatever profit element you are using onto it. And then moving on, based on the categorization and the policy, we have to go on and select one of the most appropriate transfer pricing methods. So as per the UACT law, we have 5 transfer pricing methods, and those need to be tested in terms of what the nature of transaction is. So for example, if it's an intercompany financing arrangement, we could look at CUP method, which compares pricing with intercompany loans on the market. Or if it's like a manufacturing entity, we could look at having a cost plus method. And also we can sort of look into the applicability of a transactional net margin method, which tests your entity level profit margins and compares them to third-party comparables. Now, once we have performed a benchmarking analysis and we have identified comparable companies with whom we receive an interquartile arm's length pricing range, we would move on to testing whether your entities are within those within those arm's length range or not. And this is an exercise which ideally should be done before you sort of close your books, because if there has to be made an adjustment on either your services or on the purchase of your good or sale of your goods, that could also have an impact on your VAT as well as on the custom declaration that you have made. So transfer pricing is just not about corporate tax, but it also sort of moves on and takes and has an impact on your VAT as well as on your withholding taxes. It could have an impact on your customs. And when you take into account that these laws are extend also to the transactions with your related party, which are overseas, that adds a completely different significant risk element to it. So these are the 4 steps that, and ideally a transfer pricing taxpayer should be taking into account, and an exercise which for taxpayers who are closing their books by 31st December, you should either have started this or should be in the middle of this. And for taxpayers whose books are closing on the March 31st, and at least you have enough time to start on with this exercise and go into a much more deeper detail. So moving on,
Sahil,
yeah,
just
go ahead.
hold on. Yeah, but I see some participants have raised their hands. I would request you to please type in your questions. We will not be taking any queries over a voice or through audio or through video. Just type in your questions and we will address them. If we can't address them in this session, we will take them up separately after the session. Thank you.
Thank you, Prateem. Yeah. Yeah, so now what we have done is we have prepared an year-end checklist. The first one of that will start from reviewing of intercompany agreements. Now, where you already have existing intercompany agreements, it must be ensured that all of the transactions and the substance which are supposed to come out of the agreements are aligned with your wide overall transfer pricing policy, not only for the domestic UAE, but as well as for your overseas entities. Now, there could be situations where you might have existing intercompany agreements, but they were prepared based on the transfer pricing policy of your related party in another jurisdiction. So it's very important that you review these intercompany agreements and ensure that they meet any specific guidelines or requirements from the UACT law as well. Second point would be the second point would be to validate the domestic and cross-border transactions. What this means is, as we covered in the last point, if you have not done an RPT mapping, it's very essential at this stage that you have identified all your related party transactions to ensure that they're compliant under the new rules. If and foremost, like as I mentioned, payment to the KMP or connected persons are something which other jurisdictions do not take into account, but it is an applicability for the UAE. So it's quite important that we deal with those transactions as and when possible, including interest-free loans or shareholder loans. Now, those are transactions which are just UAE specific. So it's very important that we validate these transactions before we move towards closing our books. The third point would be the conducting a transfer pricing risk assessment. Again, technically, this should have been done pretty much earlier, but if it's not done, we can sort of include this scope as part of a TP policy formation. And what this means is the identification of high value and high risk transactions. So these could include, specifically as Prateem and Maulik mentioned, that if you are transacting between your free zones and your mainland entities, then your free zone transactions have to comply with the arm's length provisions for you to be benefiting from the 0% corporate income tax. From a transfer pricing perspective, free zones have given a list of transactions which are supposed to be qualifying activities when you're providing them to your mainland or your overseas entities as well. So it's very important that if you have those charges, we sort of have a look at those transactions and ensure that you are complying with the qualifying activity list. And if not, then the non-qualifying activities are not breaching the de minimis threshold of 5 million dirhams. So this pricing assessment, transfer pricing risk assessment, could be done along with the TP policy, but for books which are being closed on 31st December, it is very important that this exercise starts as soon as possible. Moving on, the fourth point would be a continuation of the TP policy, whereas you have to align your accounting and transfer pricing policies. So what does this mean? Now, there could be a situation where your financial statements are not going to be aligned with your tax accounting methods. So for example, in our experience, we have seen that with certain entities, there's an intercompany loan which has been provided, which is either recognized as a shareholder loan in one of the entities parties and a regular long-term loan in the other entity. So these transactions have to be identified and an adjustment has to be made in the books of both the parties. Also, like the one example is that continuing from the example that I gave for the intercompany loan, now where it is treated as a shareholder loan, there might be a situation where it's an equity contribution and the interest has actually been considered as a dividend payment instead of an interest payment. So this could lead to a disallowance of the interest expense in the payer's books because that could be considered as a dividend. Now, these accounting principles and transfer pricing, accounting policies and transfer pricing policies have to marry each other. And because this is the first year of taxation, this could be a pretty detailed exercise on which both the corporate tax team, the accounting and finance team, and the transfer pricing team have to sort of come together and make sure that you are compliant with these policies. Moving on, the first checklist would be to ensure that you actually have that you have a proper benchmarking analysis being done for your related party transactions, and then use those benchmarking numbers to ensure that the transaction that you are undertaking with your related parties fall into the arm's length range. Now, usually globally, it's the FTA or any other tax jurisdiction globally, they prefer your arm's length range to be close to the median because that sort of gives them the comfort that you are at the median range. But however, when you test this arm's length pricing and you find that your margins are either closer to the lower quartile or are maybe like above the median, then it becomes paramount for you or taxpayers to ensure that you have enough substantiating documents in terms of functional analysis and a value chain analysis to show why your margins are either lower than the median or higher than the median. And this should be documented in a proper TP documentation or an internal policy document. Moving on, once you have tested your arm's length pricing, as I mentioned, it's also important to monitor the connected person transactions because it's very easy for these to skip out, right? So for example, as I mentioned, you might have given an apartment on rent, which is not coming into the books or might be considered in some other miscellaneous expenses. So those have to be delineated to have the exact value for these books. There could be certain other expenses which could be considered as business expenses, and however, they might not be covered or deductible under the CT business expenses because those might be undertaken for a personal use. So for example, if you're leasing a car, as per the CT, it should only be used for business expenses, but it might be difficult for us to sort of differentiate like how much time for the car is being used for work versus non-work. And therefore, it's important that we have robust internal policies which sort of define how much is the percentage that should be used for the business and what would be the personal expense. And those policies help us support and defend our deductions in the corporate tax as well. The seventh point, once you have done the connected persons, is plan for VAT and customs adjustment. So when we move closer to the closing of our books and we have enough and we have enough benchmarkings and transactions being done. And if there are any adjustments, we need to be aware that these adjustments might need for you to revise your VAT valuations or even the customs valuation. And these could have any penalties or interest which might be coming from these transactions. Therefore, the sooner we do this exercise, the better it is for taxpayers as well. Moving on, I think we have preparing for year-end audit. This is, of course, going to be done along with the corporate tax team, where we are ensuring that we have enough supporting invoices, supporting documents, intercompany agreement for distribution, manufacturing, whatever services you have, allocation policies are taken care of, and you have all the supporting documents that would help us or actually help you to ensure that the deductions that you have taken in your books are as per the law. And finally, the last point would be to have a documentation strategy. Now, this documentation strategy would include your disclosure forms, which are supposed to be filed with your corporate tax return, as well as your local file and master file if you are breaching those thresholds. We will be taking another webinar to take you through the compliance and documentation requirements, because that's an entirely separate chapter. But it's important to note that these guidelines do exist. And if you have any specific questions for this, we are happy to take it off the record and reach out to you personally if you can just list your questions here. I think we are supposedly towards the end of the engagement, but I'm going to go through the next slide pretty fast. Prateem, you can just keep on moving with the slides. These are some of the intercompany transactions where we have faced, where we have faced certain challenges, especially in the head office service charges. Make sure that you have conducted the benefit test, which means that the services have been rendered. You have intercompany agreements and invoices. Your allocable cost base is appropriately calculated, and you have appropriate allocation keys linked with the service being rendered. For trading of goods, it becomes important to identify what are the functions your traders are doing. Are they low-risk distributors, full-fledged distributors, and accordingly the characterization has to be maintained, and the arm's length margin would depend on that. For intercompany financing, financing should be for a commercial and a business purpose. It should be taken care of, whether it's formed part of a debt or an equity, and if it's a debt, whether you are within these thin capitalization margins, or and you have conducted debt capacity analysis, you have credit ratings and interest rate benchmarks. For guarantees, ensure that if it's an explicit guarantee, that the determination of a guarantee fee is taken care of. And for rental, lease, and royalty, again, you need to have a robust transfer pricing policy, that these could be very challenging when it comes to your transactions. I think this is for transfer pricing. I mean, we are running out of time, so I'm covering all of this in short. We will be sharing the presentation with you, and you can reach out to me if you have any questions on the specific transactions. And the final question, Prateem, if you can go to the next slides. What we always hear from our clients is that if we already have existing transfer pricing global policy, would that work in UAE? The answer is yes and no, because as I mentioned, UAE has certain specific guidelines on certain transactions which are not really covered. The benchmarking might not be applicable to the UAE because it's also dependent on the geographies. So it's on a case-to-case basis, and we're happy to sit down with you and have a review of those policies and let you know whether those are applicable or not. Thank you so much for joining us, and we have your questions. I think, Prateem, do we have time to take those questions now, or are we reaching out?
We are short of time, but I think we can take a few quick questions.
Yeah.
And I think I have gone through some of the questions, so I'll direct some to Maulik, some I'll take up, and some to you. Quickly moving on, I think one is, if a company prepares its financial statements in USD, do they need to mandatorily move to AED? Not from a IFRS perspective, but corporate tax law says that you have to compute a tax liability in AED. So practically speaking, if you're preparing in USD, you have to convert all your financial statement items to AED. It has to be done maybe, at a transactional level also, and you have to maybe do it at a monthly, or at the time the transaction takes place, you have to check your, exchange rate as per the central bank at the date, or on a monthly basis or on an annual basis. But it helps that AED is pegged to the USD, so it should not be very complex. But as a recommendation, you can do it in AED. One for TP Sahil, control in the form of significant influence could be the case where let's say more than 90% of raw material is purchased from a related party, right? Because this is covered in Indian TP regulation.
Yes, it is. Like that would be constituting a related party transaction. There are certain exceptions to this in terms of if you can sort of show that you have gone onto the different markets and taken certain materials from different third-party unrelated parties, but it might not be meeting the quality requirements, or it's not as per, or at least as per the market price, you have tried to find those products. But if it's an exclusive product that you're buying only from your related parties, more often than not, FTA would be taking a position where it would be considered a related party, as your business is dependent on that purchase.
Okay. One question, again, a TP question.
Yeah.
Are intercompany arrangements like interest-free loans required to be at arm's length? I think the answer is pretty obvious, Sahil.
Yes,
Yeah.
I think I mentioned in the previous case as well. Yes, it has to be at arm's length. Now, interest-free loans have to be defined in two ways, like whether they are forming part of an equity transaction or an equity contribution, or are they partly pure commercial loan. So if it's a pure commercial loan, then yes, it has to have an arm's length interest. However, if it meets certain guidelines that have been provided for it to be an equity contribution, then it could be considered as an equity contribution. Hence, no interest is required on those. But in either of the two cases, you have to evaluate those loans and then appropriately create an intercompany agreement, which sort of brings out the transfer pricing policy that is in effect for those loans.
A corporate tax question, Maulik, if you can answer, what is the process of making the election, say, for realized, unrealized basis? Is it at the time of registration or at the time of CT return filing?
Yes, I think we touched on this, and I think it's essentially at the time of the CT return filing. But then again, there's a lot of consideration that goes into it. So you have to invest a bit of time to figure out if it's actually beneficial for you. But to answer just the question, it has to be made with the CT return itself. So if you make that election, then there are certain other fields and boxes that you have to populate.
Another important question, I think, from mainly compliance, I can take this up that, we are a company that's incorporated in September 23 for a financial year of Jan to December. What will be my first tax period? Quickly, broadly, the corporate tax law and its supporting clarifications have said that a financial year is linked to the company's law in the UAE. Company's law in the UAE does not allow a financial year of less than 6 months. So effectively, your financial year will be an extended financial year from September 23 to December 24. So that will be, from September 23 to December 24. And you would have to do your compliance in 9 months from December 24. That's September 25. Hope that answers the question. Okay, one more question is that, okay, this is very important, Sahil. I think this is linked to the recent guide. For corporate tax and local file and the TB disclosure form, the revenue exceeds 200 million, but related party transaction is less than 4 million, where the master file local file is required to be prepared.
Yeah, I was going to pick up this. So that there have been certain non-alignment between the TP documentation requirements and the threshold or the disclosure form requirement. So the 4 million transaction value is for disclosing a transaction as part of a disclosure form, which goes with your corporate tax. And the way the guide, the UAE CT guide has been worded means that for TP documentation, you have to prepare it if you breach the 200 million threshold, and there has been no exemption given to it. Now, whether we need to go into a deeper analysis and report these transactions in the RPT TP documentation or not is again going to be subject to a case-to-case basis, or if we receive a further public clarification. But at the present moment, my conservative approach would be to sort of at least have a TP policy internally, which could be sort of extended into a transfer pricing documentation if the need is required. But having a TP policy, which is an internal document, shows your readiness and the fact that you have taken into account all the other guidelines to be ready for the first tax period.
I think we just have time for one last question.
Yeah.
I will shoot this at Maulik. If I have withholding tax withheld for a dividend that I've received from the KSA and I'm a holding company in UAE, can I claim a foreign tax credit in the UAE?
Yeah, you can claim that credit in accordance with Article 47 of the UAE CT law, right? But I think so the guide that was issued on corporation tax computation, it mentions a specific formula that you have to follow, and also the credit that you're claiming cannot exceed either the UAE CT rate or the KSA CT rate, whichever is lower.
Yeah, so effectively, I think, Maulik, that if the dividend is exempt in UAE or the UAE entity is at a 0% corporate tax rate, you cannot claim a FTC credit on something that you're not paying a UAE corporate tax on. Yeah. And I think we had any questions. This is all the time that we have. Any questions that have remained unanswered, don't worry, we will reach out to you individually and hope to tackle those queries of yours and give you guidance on that perspective. Thank you for joining us. Do remember to follow us on LinkedIn and other socials. Our contact details are saved, are shared on the screen. You can reach out to us or visit our website as well. Thank you all for joining.
Thank you, everyone.
Thanks so much. Thank you.